Hey, everybody, this is Carl White broadcasting from the front porch out here at the secret headquarters of the Mortgage Marketing Animals. You're listening to Loan Officer Freedom, #1 podcast in the world today, and only because you knew someday that I'd be interviewing the great Kevin Gillespie. So Kevin's in charge of a part of the Freedom Club that's called Branch Manager Academy. And Kevin, good to see you, my brother.
Good to see you, man. It's been a little while. You've been traveling, so it's good to catch up.
It is good to catch up. Hey, so this is an impromptu recording that we're doing because you and I were just talking offline and talking about some of the pricing and the competitiveness and people changing companies to get better pricing. And you brought up a great statement that I thought was worthy of a lot of people listening to. And so I said, hey, hang on just a second. Let me click the record button here and let's get this on tape. So
Okay.
Bring everybody to see what you and I were just talking about.
Well, it's in our coaching right now. A lot of folks were coaching branch managers and, brokers are they're looking for the best price. It's a very competitive price market right now. And rightfully so. But with that said, people are thinking, well, should I move companies? I get that question a couple times a week. And, what should I do? And I'm going to share my thoughts. And I want to give a disclaimer. One, I don't know that I'm the best person to talk about this, but I got a little insight into it. And I'd welcome anybody else's input to help educate everybody. But with that said, we all know, we all hear the news about rates are going to continue to go up a little bit, even though the economy does seem to be slowing. And so the Fed is talking about some rate hikes still for the next couple of months. Hopefully they back off that pretty quickly, but they will, and they already have jumped things quite a bit. And people are saying, yeah, but these other companies are pricing so good. I got to get to the lowest price. Well, I personally think that's going to stop over the next 30, 60, 90 days. And the reasons are kind of two or three, is my thinking is one, Fannie Mae, my understanding, has come out with an announcement saying that you cannot lose money in a quarter and sell them loans. Used to be they gave you a leeway of a quarter or two because everybody could have up or down or you're growing or whatever. And so if that's true, that's going to force a lot of these companies to, and even the aggregators, it's going to force them to watch their pricing if they've been pricing under the market because they cannot afford to lose money. Then the other one is the banks that, banks have been very aggressive in credit unions as far as some of their ARM pricing. Well, unless a bank has a ton of money in its portfolio, they can only invest a certain portion of their portfolio into mortgage loans. And so if they're borrowing the money from the Fed, well, Fed funds last year were at 0.125. It's projected, and right now they're about 2.75 to 3, and it's projected they're going to go to 3.75 to 4, and that's because of the Fed raising rates. Well, if that happens, some of that craziness in the ARM pricing may also go away. And then the third piece of it is there are some companies, if they're not having to sell their servicing, what they're doing is they're tending to upgrade their servicing value. And if they're all their loans are older ones on the books from last year, the year before at very low rates, there is an increase, but that's limited what they can increase it. So the people playing any games with servicing value, that will still come back to how much cash do they have on hand type of issue. And so with all that said, without trying to confuse people, all I'm saying, it's a very fluid, very rapidly changing market. And just, we will likely see things balance out again in the next 30, 60, 90 days. I hope I'm right. I don't know that I am, but that's kind of the thought process, Carl.
All right. So, I just want to make sure I understood what you said here, because you're way more involved with this, just, being perfectly transparent than I am, that you're one of my biggest sources of information of this kind of thing. So what you're saying is if I've been having my butt kicked here by some of the local big banks, that if they're selling to Fannie Mae has said you cannot price your loans under the market and actually lose money for a quarter or two trying to gain market share, because we won't allow you to. Because if you lose money for 2 quarters in a row, we're not going to buy your loans anymore. And so it's
Yeah,
going to.
well, that's it, mainly for correspondent lenders there. Because if the bank could be making great money in other areas and not going negative, and they would probably be okay. But banks usually, it's more the other correspondent lenders that are very aggressive, whether it's a wholesaler or it's a retail lender. They cannot go negative. Banks either, but some banks have other revenue streams.
Yes.
And so, but the bank arm pricing, because of where Fed funds is going and the limit they have in their portfolio, I think that will change also. I hope that makes sense.
Yeah, I get it. So this tightening or this margin compression that we're seeing is likely going to come to an end within the next couple months because they can't afford to lose money.
I hope
on their P&L, or that's the thought, that Fannie Mae is not going to allow them to lose money on their P&L trying to gain market share. Even if they got it in their coffers, they can afford to lose money. That Fannie Mae is saying, no, we're not going to allow you to do that. We want to make sure that you have stability, and this is that your business plan is one of making a profit, because then you do have the stability. And so this, what sometimes we call the race to the bottom, we should be seeing an easing up on that in the next month or two, that it'll be more of a level playing field going forward. And that again, these ARM products that are so cheap, that should be coming to an end also, because the money that they're paying for that money is being increased. And so people that are scrambling around trying to look for a different platform because they're getting an eighth better in price might want to hold off on that just a little bit, because it's likely the playing field is going to become a lot different in a better way, like in a good way, that will get back more to a normal pricing and normal margins kind of thing. Is that kind of the basic synopsis of it?
I think so. And I hope so. And then at the same time, with the market being off, more and more people getting out of the business. So it'll take some time to work through. You and I've been through this 3 or 4 times in our career, and it shakes out. It'll balance out. There are always somebody a little crazy out there doing something, but I think we'll get a better balance in the next 30, 60, 90 days is what I'm hoping.
You know what I find is that, last year, literally, my mailman, I was out going to check my mail, and the mailman comes by, and he's doing the thing in the mailbox, and I'm sitting there waiting for him, and he motions me over, and I go over to him. He said, because we know each other, I've had the same mailman for years. And he said, Carl, you're in the mortgage business, right? I see your mail, you get a lot of mortgage. So you're in the mortgage business, right? And I go, yeah. He said, well, I've been thinking about refinancing. And so literally we were getting deals coming in literally from just like going out to the mailbox and checking our mail, getting flagged down by the mailman, And so it was like really super easy to do, like to bring loans in. And now that we actually have to do salesmanship or salespersonship, whatever the right way to say it, it's going to, a lot of people are going to get out of the business that don't know how to sell. Like they're not true. They're order takers instead of salesmen or saleswomen. We're going to see a lot of people get out of the business. And what I predict, Kevin, is the same thing that we saw on the like the 07, 08, 09, that on the other side of it, man, we never had it better. Like it flushed out all the people that were part-time taxi drivers and part-time mortgage, loan officers. And again, nothing against taxi driving, right? I think it's an awesome career. But those people that weren't serious about the business and they were just opportunistic, getting into it because they thought, this was a get rich quick scheme, which is definitely not. It's a get rich plan, but it's a get rich long, not get rich quick kind of plan. That with the flushing out of all those people, man, it was never better for us. And I think the exact thing's going to happen again this time, is that we're going to flush out all the taxi cab drivers and all the hairdressers that, flipped over to mortgage for a short time. But it's nice to know that this pricing issue that we're seeing, and it's a headache, right? For us too, we're a high volume shop like you are. It's been a headache. That there's going to be an easing of that coming up. So basically, we're telling everybody, hey, get away from the ledge. It's going to be okay. That this is a short period of time, and this pricing will become more normalized in a short period of time, we think.
Yeah, I hope I'm right. If you got a different opinion, let us know. No hate mail. I'm not throwing darts. I'm just an observation, and I'm not 100% right. So I could be wrong, but I'd love anybody else's opinion to help feed us more knowledge, right?
Well, I don't know how this couldn't be right. Like if they're making a new statement of, hey, you can't lose money and you can't price your loans below the market and lose money to gain market share, or you can't sell to Fannie Mae anymore. Man, that's a great indication that's a great solution to this issue. And you can understand why Fannie Mae would do that, of course, because it's just like the warehouse lines we have, at the company that I work with. The warehouse, man, if you're not making money, they'll turn off your warehouse, right? They want to make sure that you're profitable. And, so we're always, very careful and look at our P&L to make sure we're running in the positive, so we don't get in trouble by the warehouse lines. And so Fannie Mae obviously looks at this the same way. And so anyway, so that's great news. One other thing. So what Kevin is in charge of our Branch Manager Academy, where he works with a lot of top level branch managers throughout the country, and also loan officers that are thinking about being a branch manager. Kevin runs a great program where he walks through step by step of exactly what to do. And then you're working shoulder to shoulder, elbow to elbow with some of the top branch managers in the nation. I'm in that group also, where we all share ideas back and forth to each other. And if you'd like to be a part of that or find out what we do, we'll set you up with a call to give you a sample of what these meetings that we have look like. And if you go to freedomclubdemo.com, we would love for you to see what one of these high level coaching calls or group calls looks like, and we'll give you one, right? No charge, no credit card, no teaser or anything like that. You can have it for free. And I'm convinced you'll see of how much we can move your needle in one simple 45-minute one-on-one phone call. I think it'll blow you away enough that you'll want to join us, but either way, it's totally cool. So did I miss anything there, Kevin?
No, sure didn't.
Think I covered it?
Good.
All right. Hey, thanks everybody. So, hey, feel free to, in fact, would ask you to forward this to any of your loan officer friends that you think would benefit from it, and would the knowledge of stability is on its way is a really good message to be sending right now. So thanks a lot. Thanks for all the reviews, freedomclubdemo.com, and we'll talk to you when you call in. Thanks again, Kevin. I appreciate you, brother.
Thanks. Okay, man. Appreciate you, friend.